Before we dive in, a quick but important note. The information in this video is for educational and informational purposes only, and is not intended to be a substitute for professional financial advice. I am not a licensed financial advisor, mortgage broker, or loan officer. The housing market, lending requirements, and interest rates are constantly changing. Always consult with a qualified professional before making any major financial decisions. This presentation is based on the lending landscape in the United States. You're scrolling Zillow at 2 in the morning again, aren't you? You found it. The one. It has that open concept kitchen you've been dreaming about, a backyard big enough for a dog, and it's in that perfect neighborhood you thought you were priced out of. You can already picture where your couch will go. But then that cold, heavy feeling drops into the pit of your stomach. The question that stops the dream dead in its tracks. Can I even get a loan for this? For millions of Americans, that question is a wall. A giant, confusing, terrifying wall. In fact, a recent study showed that nearly 40% of first-time home buyers are denied a mortgage on their first try. 40%. And here's the brutal truth. For most of them, it was completely and totally avoidable. They weren't denied because they couldn't afford a house. They were denied because they didn't understand the game. And make no mistake, it is a game. A game with very specific rules that are intentionally kept from you. The mortgage industry is built on jargon, complex formulas, and a mountain of paperwork designed to make you feel small, confused, and desperate. They want you to feel like they're doing you a favor. But today, right now, we're flipping the script. I'm not just going to give you a few tips. I'm handing you the lender's secret playbook. This is your 2026 guide to not just applying for a home loan, but to walking into that bank or mortgage broker's office with so much confidence, you'll be the one in control. By the end of this series, you will know exactly what they're looking for, why they're looking for it, and how to position yourself as the perfect, undeniable, approved candidate. We're going to break it all down into what I call the 4 pillars of mortgage qualification. These are the 4 legs of the table that your entire application rests on. Get these 4 things right and you're virtually unstoppable. They are credit, income, assets, and debt. Today we're starting with the big one. The one that causes the most anxiety and the most confusion. We're talking about your credit score. Now, you've probably heard a million things about your credit score. You need a 750. No, a 680 is fine. Pay off all your cards. No, keep them open. It's a mess of conflicting advice. So let's cut through the noise. Your credit score is not just a random 3-digit number. Think of it as your financial report card. It's a summary of one single thing. Your history of keeping your promises. When you borrow money, you're making a promise to pay it back. Your credit report is the detailed history of how well you've kept those promises. And to a lender who is about to hand you hundreds of thousands of dollars, that history is everything. It's their number one predictor of whether you'll pay them back, or whether you'll become a problem. So, what number do you actually need? While it changes slightly with the market, here's a general breakdown for 2026. A score of 740 or higher is considered excellent. This is the top tier. With a 740 plus score, you're getting the best interest rates, the lowest fees, and you'll have access to almost any loan program. You're a low-risk borrower, and lenders will compete for your business. The next tier, from about 680 to 739, is considered good. You'll still qualify for most conventional loans and get competitive rates, but they won't be the absolute best on the market. This is where the majority of homebuyers land. Below 680, things get a bit trickier. From 620 to 679, you're in what's often called the fair or subprime category. You can still get a loan, especially government-backed loans like an FHA loan, but you will absolutely pay for it. Your interest rate will be significantly higher, and you might be required to have a larger down payment or more cash reserves. And below 620, it becomes very, very difficult to secure a traditional mortgage. It's not impossible, but it's a serious uphill battle. Now, why does this matter so much? Let me put it in real dollars. Let's say you're getting a $400,000 loan. A borrower with a 760 score might get an interest rate of 6.5%. A borrower with a 660 score might get a rate of 7.5%. That 1% difference sounds small, right? Wrong. Over the life of a 30-year mortgage, that 1 percentage point will cost the 660 score borrower over $95,000 in extra interest payments. $95,000. That's a brand new luxury car, a college fund, a life-changing amount of money, all lost because of a 100-point difference in a credit score. This is why we're starting here. Getting this right is the single most powerful thing you can do to save yourself money. So how do you know what your score is? First, you need to understand that you don't have just one credit score. You have many. But for mortgages, lenders will pull a report from all three major credit bureaus: Equifax, Experian, and TransUnion. They will then take the middle of those three scores. So if your scores are 720, 730, and 740, they will use 730 for their decision. They don't average them and they don't take the highest or the lowest. They take the middle one. This is a critical piece of information most people miss. Your first action item today is to get a copy of your full credit report. Not just the score from a free app, but the actual report. You are legally entitled to a free report from all three bureaus once a year from the official government-mandated website, annualcreditreport.com. Go there, pull your reports, and check them for errors. A simple mistake like a debt that isn't yours or a late payment that was actually on time can tank your score. Fixing these errors is the fastest way to see a jump. Once you have your report, let's talk about how to improve that score. Your score is made up of 5 factors, but 2 of them are the undisputed giants, making up 65% of your entire score. The undisputed king at 35% of your score is your payment history. Do you pay your bills on time? Every single time? That's it. One late payment from 30 days ago can drop an excellent score by 60 to 100 points. Is that devastating? The most important thing you can do starting this second is to set up automatic payments for at least the minimum amount on every single one of your debts. Car payment, credit cards, student loans, everything. Never ever miss a payment again. The queen sitting right next to the king is credit utilization, and it accounts for 30% of your score. This is simply the amount of credit card debt you have compared to your total credit limit. If you have one credit card with a $10,000 limit and you have a $5,000 balance on it, your utilization is 50%. The golden rule is to keep your utilization below 30% on every single card, and across all your cards combined. But if you want to play in the big leagues and really boost your score for 2026, the new magic number is under 10%. Keeping your balances low signals to lenders that you aren't living on credit, and you manage your finances responsibly. It's a massive sign of strength. The other factors are length of credit history 15%, credit mix 10%, and new credit 10%. The quick takeaways here are simple. Don't close your oldest credit card, even if you don't use it. That long history is valuable. And most importantly, do not go out and open a bunch of new credit cards or get a new car loan in the 6 to 12 months before you plan to apply for a mortgage. Every time you apply for new credit, it dings your score with a hard inquiry, and it lowers the average age of your accounts. To a lender, this looks like you're suddenly desperate for cash, which is a huge red flag. Put yourself on a credit freeze. No new accounts until after you have the keys to your new house in your hand. Mastering these 4 things, paying on time, keeping balances low, maintaining old accounts, and not applying for new credit, is the entire secret to building a mortgage-ready credit profile. It's not magic, it's just discipline. Now you have a deep understanding of the first and most important pillar, credit. You know what score you need, how to check it, and the exact steps to improve it. But a great credit score is useless if you can't prove you can actually afford the monthly payment. And that brings us to the second pillar, the one that's all about the money you bring in, income and employment. How much do you need to make? Does your side hustle count? What if you just changed jobs? We're going to break all of that down next. Let's start with the biggest question. How much money do you need to make to buy a house? The honest answer is, there is no magic number. A lender doesn't care if you make $50,000 a year or $500,000 a year. What they care about is the relationship between your income and your debt. This relationship has a name, and it is the single most important metric in this entire pillar, your debt-to-income ratio, or DTI. Imagine your monthly income is a big bucket. Every month, you fill that bucket with your paychecks. Now imagine every single one of your monthly debt payments, your car loan, your student loans, your credit card minimum payments, is a small hole in the bottom of that bucket. The lender wants to see how much water is left in the bucket after all those leaks. They need to be sure that when they add one more very large hole, your new mortgage payment, the bucket won't run completely dry. That percentage of your income that's already spoken for by debt, that's your DTI. Lenders look at 2 types, but one is far more important. The first is the front-end ratio. This is simple. It's just your future housing payment, that's principal, interest, taxes, and insurance, divided by your gross monthly income. If your new mortgage is projected to be $2,000 a month and you make $6,000, your front-end DTI is 33%. But the one they really scrutinize is the back-end ratio. This is the big one. This is your total monthly debt, that new mortgage payment plus your car payment, your student loans, your credit card minimums, any other loans, all divided by your gross monthly income. Let's use that same example. You make $6,000 a month before taxes. Your new mortgage is $2,000, but you also have a $400 car payment and a $300 student loan payment. So your total monthly debt is $2,000 plus $400 plus $300, which equals $2,700. $2,700 divided by your $6,000 income gives you a back-end DTI of 45%. So what's the magic number for DTI? For most conventional loans, lenders want to see that back-end DTI at or below 43%. This is the unofficial industry standard, a line in the sand drawn by government regulations. However, this is not a brick wall. With a high credit score and significant savings, some lenders will push that number to 45, 47, even 50%. Government-backed loans like FHA and VA are even more flexible, sometimes allowing DTIs well above 50%. Think of 43% as the target, but not the absolute limit. Knowing your DTI is your superpower. It tells you exactly how much house you can afford in a lender's eyes. But it all hinges on that top number, your income. So what exactly does a lender consider to be stable, verifiable income? The absolute gold standard is W-2 income. If you get a regular paycheck from an employer with taxes taken out, you are a W-2 employee. Lenders love this because it's predictable. They can look at your pay stubs, see your year-to-date earnings, call your HR department to verify you still work there, and feel confident that the money will keep coming in. The general rule is that they want to see a 2-year history of employment. Now this is where people panic. 2 years? But I just switched jobs 3 months ago. Am I disqualified? The answer is almost always no, as long as you made a smart career move. If you were a marketing manager at one company, and you left to become a senior marketing manager at another for a 20% raise, a lender sees that as a positive. It's a stable career path with upward momentum. They just need your offer letter and your first pay stub to prove it. Where it gets tricky is if you make a complete career change. If you were a nurse for 5 years and just quit to become a freelance graphic designer, a lender has no way of knowing if your new career will be stable. In that case, you'll likely need to build up a 2-year history in your new field before you can qualify. This brings us to the fastest growing part of the American workforce: the self-employed, the freelancers, the gig workers, the 1099 contractors. Can you get a mortgage? Absolutely. But the rules are different and they are strict. If you don't receive a W-2, lenders can't just look at a pay stub. They need to see your federal tax returns, usually the last 2 years' worth. And here is the most critical piece of information for any self-employed person to understand. Lenders are not looking at your gross revenue. They are not looking at the total amount of money your clients paid you. They are looking at your net income, after all of your business expenses and write-offs. Let's say you're a freelance consultant and you billed $100,000 last year. Amazing. But on your tax return, you wrote off $20,000 for a home office, a new computer, travel, and software. Your taxable net income is $80,000. The lender will qualify you based on that $80,000 figure, not the $100,000. Many self-employed people try to write off as much as possible to pay less in taxes, which is smart tax strategy. But it directly hurts your ability to qualify for a loan. For the 2 years leading up to your home purchase, you have a choice. Pay more in taxes to show a higher net income, or pay less in taxes and qualify for a smaller loan. You can't have it both ways. And what about that side hustle? Does your Etsy shop, your weekend door dashing, or your consulting gig count? Yes, but only if you've been claiming it on your tax returns for at least 2 years. That under-the-table cash you get for random jobs doesn't exist in the eyes of a lender. If it's not on a tax return, it's not real income. Beyond your primary job, other sources of income can also be used. Things like Social Security, disability, pensions, alimony, or child support all count. The key here is documentation and continuance. You'll need the official award letter or court decree. And you'll need to prove that the income is likely to continue for at least 3 more years. For child support, for example, if your child is 17 and a half, a lender won't count that income because it's set to expire in 6 months. Income from investments like dividends or capital gains can also be used, but again, you'll need a 2-year history of receiving it, and the lender will want to see that you still own the assets generating that income. So we've covered what counts. What doesn't count? One-time windfalls are a big one. An inheritance, a gift from a relative, or even lottery winnings don't count as income. They are assets, which we'll cover in the next part, but you can't use them in your DTI calculation. A lender needs to see a stable, recurring pattern. Projected income is another. You might have a signed letter from your boss promising you a huge raise in 6 months, but until that raise appears on your pay stub, it's not real. Lenders only work with your current, documented reality. Finally, income has to be verified. A lender won't just take your word for it. They will use your pay stubs, your W-2s, and your tax returns. They will also perform what's called a verification of employment, or VOE. This is where they directly contact your employer's HR department to confirm your dates of employment, your position, and your salary. They usually do this once at the beginning of the process and then a second time right before you close on the house to make sure you haven't quit or been fired. It's a final check to ensure nothing has changed. So, the second pillar, income and employment, isn't about hitting a specific salary. It's about demonstrating stability and managing the ratio of your debt to your proven, documented income. It's about showing the lender that after you pay all your existing bills, there's more than enough left in the bucket to handle a mortgage payment, month after month, year after year. We've now covered your credit, which is your history of paying bills, and your income, which is your ability to pay future bills. But there's a third crucial piece of the puzzle. It's the cash, the money you've saved up, the down payment, the closing costs, the reserves. How much money do you actually need in the bank? The answer is probably a lot less than you think, and the old 20% rule is one of the biggest myths in real estate. And we're diving into your cash, your savings, and your assets next. Let's start with the biggest lie you've ever been told about buying a house. You need to put 20% down. This single piece of outdated advice has probably scared more people away from homeownership than any other myth in history. So let's kill it right here, right now. Where did this 20% number even come from? It's not some magic number for financial health. It's simply the threshold where lenders typically stop requiring you to pay for something called private mortgage insurance, or PMI. And here's the first secret you need to understand. PMI is not for you. It doesn't protect you if you lose your job. It's insurance that you pay for, that protects the lender in case you default on your loan. So, by putting down 20%, you're showing the lender you have significant skin in the game, you're less of a risk, and they no longer need that insurance policy. That's it. That's the whole reason. But what if you don't have 20%? What if you're looking at a $400,000 house and the idea of saving $80,000 feels like trying to climb Mount Everest in flip-flops? Welcome to the club. The good news is, you absolutely do not need it. The national average down payment for first-time homebuyers has been hovering around 6 to 7% for years. Not 20, 6. So how are they doing it? They're using modern loan programs designed for the real world. Let's start with the most famous one, the FHA loan. Backed by the Federal Housing Administration, this is the workhorse of the first-time buyer world. The minimum down payment? Just 3.5%. On that $400,000 home, that's $14,000, not $80,000. FHA loans are often more forgiving on credit scores and debt, which is why they're so popular. The trade-off is that you'll pay a form of mortgage insurance for the life of the loan in most cases, but it gets your foot in the door of a home you can actually own and build equity in. But maybe you have a great credit score. You've been diligent, you've paid your bills on time. You might qualify for an even better option, the conventional 97 loan. This is a conventional loan, not government-backed, offered by Fannie Mae and Freddie Mac that only requires 3% down. 3. That's just $12,000 on that same $400,000 house. And here is the killer advantage. Unlike FHA, the private mortgage insurance on a conventional loan is not permanent. Once you've paid down your loan to the point where you have 20% equity in your home, you can request to have that PMI removed forever, lowering your monthly payment. This is a game changer. Now, for our veterans, active duty service members, and eligible surviving spouses, there is the single best mortgage product on the planet, the VA loan. The down payment on a VA loan? 0. Nothing. A full 100% financing. It is an incredible, hard-earned benefit, and if you are eligible, it is almost always the best path forward. There's typically no monthly mortgage insurance, though there is a one-time VA funding fee that can usually be rolled right into the loan amount. And there's one more secret weapon a lot of people miss: the USDA loan. No, it's not just for farmers. This is another zero down payment loan backed by the U.S. Department of Agriculture. It's designed to promote homeownership in less dense areas. And you would be shocked at what the USDA considers rural. Many suburban towns just outside of major city centers qualify. There are income limits, but if you qualify, you can buy a home with literally no down payment. So, FHA at 3.5%, conventional at 3%, VA and USDA at 0%. Suddenly that mountain looks more like a hill. But, and this is the part that trips up almost every single first-time buyer, the down payment is not the only cash you need. You also need to pay for closing costs. Think of it like this: your down payment is your first investment in the house itself. It's your slice of the ownership pie. Closing costs are the fees for all the services required to make the transaction happen. It's the fee for the appraiser who determines the home's value, the title company that ensures the property has a clean history, the lender's administrative fees, prepaid property taxes, and homeowner's insurance. It's the cost of doing business. So how much are they? A good rule of thumb is to budget between 2% and 5% of the home's purchase price for your closing costs. On our $400,000 example, that's another $8,000 to $20,000. This leads us to the most important number you need to know: your cash to close. This is the real all-in number. It's your down payment plus your closing costs. So, if you're using an FHA loan for that $400,000 house, that's a $14,000 down payment plus, let's say, $12,000 in closing costs. Your total cash to close is $26,000. That is the check you will need to bring to the closing table. It's a much more manageable number than $80,000, but it's crucial you plan for both pieces of the puzzle. Okay, but we're not done. There's one final layer to your assets, and this is what we teased in the last part: reserves. Reserves are the liquid funds you have left in your bank account after you've paid your entire cash to close. This is your safety net. The lender needs to see that you aren't draining every last penny to buy the house. They want to know that if your water heater breaks in the first month, you can handle it without missing a mortgage payment. How much do you need? Typically, lenders want to see between 2 to 6 months worth of your future total monthly housing payment. And that payment is often referred to as PITI: principal, interest, taxes, and insurance. It's your all-in monthly cost. So if your PITI is calculated to be, say, $2,800 a month, a lender might require you to have at least $5,600, 2 months of PITI, left in your savings account after you close. For some loan types or for investment properties, this reserve requirement can be higher. But for a standard first-time buyer, 2 months is a very common benchmark. So you need the down payment, the closing costs, and the reserves. But where can this money come from? This is where the bank becomes a detective. They will need to source every single large deposit. You can't just show up with a duffel bag of cash you've been saving under your mattress. Any money you use for the transaction needs to be seasoned, meaning it's been sitting in your bank account for at least 60 days, which covers 2 full bank statement cycles. What if you just got a big chunk of cash? The most common source is a gift from a family member. This is 100% allowed, but it requires documentation. Your relative will need to sign a formal gift letter that explicitly states the money is a gift, not a loan, and that there is no expectation of repayment. They may also need to provide the bank statement showing the funds leaving their account. The paper trail is everything. You can also use funds from the sale of assets like stocks, bonds, or even cryptocurrency, but you must be prepared to show the complete transaction history, proof of you owning the asset, the record of the sale, and the funds landing in your bank account. You can also take a loan from your 401k retirement account, as that's considered a secured loan against your own assets. So the assets pillar of your qualification isn't just one number. It's a 3-part formula. Your cash to close, which is your down payment plus your closing costs, followed by your post-closing reserves. And every dollar of it has to be sourced and documented. So you've got your credit dialed in, you understand the cash you need. But how does the bank actually look at your paycheck? What if you're self-employed, a freelancer, or just started a new job? The way lenders calculate your qualifying income is completely different from what you see on your pay stub. And we're going to break down the exact formulas they use so you know your true buying power in the very next part. So let's pull back the curtain. When a lender looks at your income, they aren't asking, "How much do you make?" They're asking, "How much income can we count on you making consistently for the next 3 to 5 years?" Every single one of their rules, every weird calculation, all of it boils down to that one question. They're looking for 2 things: stability and a high likelihood of continuance. Your paycheck shows what you earned last week. They want to know what you're likely to earn for the next 1,000 weeks. Let's start with the most common scenario. The W-2 employee. You get a regular paycheck from a company, taxes are taken out, it's all very straightforward. Or is it? If you're purely salaried, let's say you make $80,000 a year, which is $6,667 a month, then congratulations, this is the easiest calculation in the mortgage world. The lender will take that $6,667 and use it as your qualifying monthly income. Simple. Same goes if you're hourly. If you work a guaranteed 40 hours a week at $30 an hour, they'll do the math. $30 times 40 hours times 52 weeks divided by 12 months. Your qualifying income is $5,200 a month. But here's where it gets tricky for millions of people. What about overtime? What about bonuses? What about commissions? This is where that 2-year history becomes non-negotiable. Let's say you're that same hourly worker, but you also crush it with overtime. Last year you made $20,000 in overtime. The year before that, you had a slower year and only made $10,000 in overtime. You might think, great, I'm making an extra 20 grand a year. But the lender doesn't see it that way. They see inconsistency. To smooth it out and find a predictable average, they will add the 2 years of overtime together. $20,000 plus $10,000 is $30,000, and then divide it by 24 months. That comes out to $1,250 a month. So they will add that to your base pay. They will not use your most recent best year. They will always use the 24-month average. The same exact formula applies to bonuses and commissions. You need a 2-year history of receiving them from your employer, and the lender will average them out over 24 months. Now here's a critical detail. If your most recent year's bonus was lower than the year before, they might only use the lower number, or ask for a letter from your employer explaining why. Remember, they're obsessed with stability. A downward trend is a massive red flag. This brings us to the new job question. What if you just started a new job a few months ago? If you moved from one salaried W-2 job to another salaried W-2 job in the same industry, you're usually fine. Even if you got a big raise, they'll typically accept that new higher salary with just 30 days of pay stubs. Why? Because the type of income is stable. But if you switched from being a salaried accountant to a 100% commission-based real estate agent, you just hit the reset button. The lender will see that as a brand new and proven income stream. You will likely need to build a full 2-year history in that new role before they'll even consider that commission income. It's a brutal truth that sidelines a lot of ambitious career changers. Now let's talk about the group that faces the most scrutiny of all. The self-employed, the freelancers, the 1099 contractors, the small business owners. This is you. Listen very, very closely. The number you see hitting your bank account every month is not your qualifying income. It's not even close. Lenders don't care about your gross revenue. They don't care if you billed $200,000 last year. They care about one thing and one thing only: the final net profit number on your federal tax returns after all your business expenses have been deducted. Let me paint a picture. Meet Mark, a freelance web developer. Mark had a fantastic year and grossed $150,000. He feels rich. He thinks he makes $12,500 a month. But to do his job, he bought a new top-of-the-line computer for $4,000. He paid for software subscriptions, internet, marketing, a co-working space, and he wrote off a portion of his car for client meetings. After all these legitimate business expenses, his Schedule C on his tax return shows a net profit of $90,000. To the IRS, that's great. He only has to pay tax on $90,000. But to a mortgage lender, his income isn't $12,500 a month. It's $90,000 divided by 12, which is $7,500 a month. And that's just the starting point, because just like with bonuses and overtime, they need a 2-year history. They will take the net profit from your last 2 tax returns, add them together, and divide by 24 to get your final, official, qualifying monthly income. If Mark made $90,000 net profit last year, but only $66,000 the year before, the bank will calculate it like this: $90,000 plus $66,000 equals $156,000. Divide that by 24 months, and his qualifying income is $6,500 a month. That is half of what he thought he was making. This is the self-employed trap. Every dollar you write off to lower your tax bill is a dollar you are taking away from your ability to qualify for a home loan. You can't have it both ways. You can't tell the IRS you made very little money to save on taxes, and then turn around and tell the bank you made a ton of money to get a bigger loan. The lender will always believe the IRS. They base their entire decision on your signed federal tax returns. So what about other types of income? Let's run through a few quick ones. Rental income. If you own other properties, you can use that income to help you qualify. But again, not all of it. Lenders will typically take the gross rent you receive and then reduce it by 25% right off the top. So if you get $2,000 a month in rent, they will only count $1,500. That 25% haircut is to account for potential vacancies, repairs, and maintenance. They're building in a safety buffer, child support or alimony. This can absolutely be used as qualifying income, but it comes with strict rules. It must be mandated by a court order or legal separation agreement. You can't just have an informal arrangement. And you must be able to prove you've received it consistently and on time for at least the last 6 months. Crucially, the terms of the agreement must state that the payments will continue for at least 3 years after your new mortgage begins. Social Security, pensions, disability. This is often the best kind of income in a lender's eyes because it's considered extremely stable and reliable. And here's a pro tip. If this income is non-taxable, many loan programs allow the lender to gross it up. This means they can increase the value by 15 or 25% to make it equivalent to what a W-2 wage earner would have to make before taxes. So if you receive $2,000 a month in non-taxable disability income, a lender might be able to count it as $2,500 for qualifying purposes. So you see, it all comes back to the same principles: documentation, history, and stability. It's not about what you feel you make or what you tell your friends you make. It's about what you can prove on paper over a sustained period of time. It's the bank's method for peeling back the layers and finding the core, reliable income they can bet a few $100,000 on. Now that we've dissected your income and figured out the exact number a lender is going to write down on your application, we've only solved half of the equation. Because your income, no matter how high, doesn't exist in a vacuum. It exists in relation to your debt. You could make $1 million a year and still get denied for a mortgage if your debts are too high. This relationship, this magic number, is called the debt-to-income ratio, or DTI. It is, without a doubt, the single most important number in your entire mortgage application. And the hidden debts, the ones you've forgotten about or don't even think of as debt, are the silent assassins of homeownership dreams. In the next part, we are going to calculate your DTI line by line and expose the surprising things that can send it skyrocketing so you can fix it before it's too late. Alright, let's hunt down those silent assassins. The weapon we're going to use is a simple, but brutally honest calculation called the debt-to-income ratio, or DTI. This isn't just a number. It's the financial MRI that a lender uses to see inside your wallet. It tells them, in cold hard numbers, what percentage of your monthly income is already spoken for by debt. And that tells them how much, if any, is left over for a mortgage payment. Get this number wrong and the gate to homeownership slams shut. Get it right and the path forward opens up. There are actually 2 types of DTI. The first is the front-end ratio, which is just your potential new housing payment divided by your income. It's important, but it's the little brother. The one that really matters, the one that makes or breaks most applications, is the back-end ratio. This is the big one. It includes all your monthly debt obligations, car payments, student loans, credit cards, plus your proposed new housing payment, all divided by your gross monthly income. This is the number we need to master. So grab a piece of paper, open a spreadsheet, or just use the calculator on your phone. We're going to do this together right now. The formula is simple. Total monthly debt payments divided by gross monthly income. The result is your DTI. Let's start with the easy part. The I for income. Your gross monthly income is your total earnings before anything is taken out, before taxes, before health insurance, before your 401k contribution. If you get a regular paycheck, look at your pay stub for the gross pay amount. If you're paid bi-weekly, multiply that number by 26 and divide by 12 to get your monthly average. If you're paid twice a month, just multiply by 2. But what if your income isn't that simple? This is where people make their first mistake. If you're self-employed or a freelancer, a lender isn't going to look at your best month ever. They're going to demand your last 2 years of tax returns and average your net income. That's your income after expenses. They want to see a stable, predictable pattern. If you made $100,000 last year but only $20,000 the year before, they're not going to use that $100,000 figure. They're going to average it, giving you a qualifying income of $60,000 a year or $5,000 a month. Consistency is king. What about bonuses or commissions? Same rule applies. Lenders need to see a 2-year history of you consistently receiving them to count that income. A one-time massive bonus from last Christmas? It's great for your savings, but it probably won't count toward your DTI calculation. They need proof that it's a reliable part of your compensation. The same goes for that side hustle. If you've been driving for Uber or selling crafts online for 6 months, that's fantastic, but to a lender, that income doesn't exist yet. You need that 2-year track record, documented on your tax returns, for it to count. So let's calculate your I. Take a moment and figure out your stable, documented, average gross monthly income. Let's use an example. We'll call her Amanda. Amanda is a graphic designer with a W-2 job. Her gross salary is $84,000 a year. Divided by 12, her gross monthly income is $7,000. That's our starting number. Write yours down. Now for the hard part. The D for debt. This is where the silent assassins hide. We need to list every single monthly debt payment that appears on your credit report or is a legal obligation. Let's go through Amanda's finances and you can follow along with your own. First, the obvious stuff. Amanda has a car loan. The monthly payment is $450. She has student loans, and her required monthly payment under her repayment plan is $300. She has 3 credit cards. Now this is critical. A lender does not care if you pay your cards off in full every month. That's a great financial habit, but for the DTI calculation, they look at the minimum monthly payment required on your statement. Let's say her 3 cards have minimum payments of $30, $50, and $40. That's a total of $120 in minimum credit card payments. So far, her obvious debt is $450 for the car, $300 for student loans, and $120 for credit cards. That's $870. But we're not done. We need to find the hidden debts. Remember those buy now, pay later services like Affirm or Klarna you use for a new mattress. If it's a loan that reports to the credit bureaus, and many now do, that monthly payment counts. Let's say Amanda has a $100 a month payment for a new laptop. We add it to the list. What about a personal loan from your bank to consolidate debt or fix the roof? Absolutely, it counts. Let's say Amanda took out a $200 a month personal loan. Add it. Now for the really tricky ones. Are you paying child support or alimony? This isn't a traditional debt, but it is a court-ordered financial obligation. Lenders absolutely count the full monthly amount as part of your DTI. It's a non-negotiable part of the calculation. And here's the biggest assassin of all, the one that derails more qualified buyers than almost anything else: co-signed loans. A few years ago, Amanda's brother needed a car, but his credit wasn't great, so she co-signed the loan for him. He's never missed a payment, it's his car, and she doesn't pay a dime. In her mind, it's not her debt, but in the lender's mind, she is 100% legally responsible for that entire $500 a month payment. If her brother stops paying, the bank is coming for her. So for the purpose of her DTI, that $500 payment is hers. There are ways around this. If you can provide the lender with 12 months of bank statements from your brother proving he, and only he, has been making the payments from his own account, some lenders may be willing to exclude it. But it's a hassle, it's not guaranteed, and it's a huge red flag you need to be prepared for. For now, we have to add that $500 to Amanda's debt. So let's recalculate Amanda's total monthly debt. We have $870 in obvious debt, plus $100 for the laptop, $200 for the personal loan, and a shocking $500 for the co-signed car. Her total existing monthly debt is $1,670. We're almost there. The final piece of the debt puzzle is the one we don't have yet: the new mortgage payment. You have to include an estimate of your future monthly housing costs. This is called PITI: principal, interest, taxes, and insurance. Let's say Amanda is looking at a house where the total PITI, including homeowners insurance and property taxes, is estimated to be $2,100 per month. Now we add it all together. $1,670 in existing debt plus the new potential housing payment of $2,100. Her total monthly debt obligation in the eyes of a lender would be $3,770. The moment of truth has arrived. We have all the numbers. Her total monthly debt, $3,770. Her gross monthly income, $7,000. We divide the debt by the income. 3,770 divided by 7,000 equals 0.538. As a percentage, Amanda's back-end DTI is 54%. 54%. Most conventional loans have a hard cap at 43%. Some FHA loans might stretch to 50%, but it's tough. At 54%, Amanda is getting an instant denial. All her hard work saving for a down payment, her good credit score, none of it matters. That single number, 54%, has slammed the door shut. She thought she was in a great position. But a co-signed loan she forgot about and a few small payment plans became the assassins that killed her dream. Calculate your own number right now. Be brutally honest. What did you get? Are you under 43%? Or are you like Amanda, staring at a number that feels like a death sentence? If your number is high, I want you to take a deep breath. Do not panic. This is not the end of the road. This is the beginning of the strategy. Because identifying the problem is the first, most critical step to solving it. And that high DTI number is not a wall. It's a puzzle. There are specific, powerful levers you can pull to bring that number down, and most of them have nothing to do with getting a massive raise. In the next part, we are going to break down the exact, actionable strategies you can use starting today to slash your DTI and transform that denial into an approval. Alright, let's start with the most common mistake people make. They look at their biggest debt, usually a student loan or a giant credit card balance, and they think, I have to get rid of that. They throw every spare dollar at this massive mountain of debt, and while that's admirable, for the purpose of qualifying for a mortgage, it's often the completely wrong move. See, the lender's DTI calculation doesn't care if your debt is a $10,000 credit card balance or a $10,000 personal loan. What it cares about is the minimum monthly payment associated with that debt. This is the secret key. Your goal isn't necessarily to become debt-free overnight. Your goal is to reduce your total monthly debt payments. So here's strategy number 1, the DTI triage. Forget the interest rates for a moment. Forget the total balances. I want you to make a list of all your debts, but instead of ordering them by size, order them by the size of their monthly payment. That $5,000 personal loan with a $300 monthly payment is a much bigger DTI problem than your $30,000 student loan with a $150 monthly payment. Your mission is to surgically eliminate the loans with the highest payment to balance ratio. That small, annoying loan you took out for new furniture? The one with the $200 a month payment? If you can aggressively pay that off and eliminate that $200 payment entirely, you've just slashed $200 from the debt side of your DTI equation. Doing that is infinitely more powerful than paying an extra $200 towards your massive student loan, which wouldn't change your required minimum payment at all. You're not trying to boil the ocean. You're trying to strategically drain the bathtub, one high payment drain at a time. Now, this leads us to strategy number 2, and this is a big one where people constantly shoot themselves in the foot. Let's say you take my advice. You find a credit card with a $3,000 balance and a $100 minimum payment. You hustle, you save, and you pay it off completely. It's at a zero balance. The first instinct for so many people is to call the credit card company and say, close the account. I'm done with you. Do not do this. I repeat, do not close the account. While it feels like a victory, closing a credit card account, especially an older one, can actually damage your chances. Why? 2 reasons. First, it impacts your credit utilization ratio. If you have a total of $20,000 in available credit and you're using $10,000, your utilization is 50%. By closing that card with, say, a $5,000 limit, your total available credit drops to $15,000. Now, you're still using that same $10,000, but your utilization just jumped from 50% to 66%. To a lender, that looks riskier. Second, it can shorten the average age of your credit history. Lenders love to see long, stable credit relationships. Closing your oldest credit card is like erasing your own good history. So the rule is simple. Pay it down to 0, then put the card in a drawer. Don't use it, but keep that line of credit open. It helps your credit score and shows lenders you have access to credit, but are responsible enough not to use it. Okay, strategy number 3 is for those of you with multiple high payment debts like a car loan and a couple of credit cards. This is the consolidation and refinance play. Let's start with your car. If you bought your car a few years ago, there's a good chance interest rates have changed or your credit score has improved. Look into refinancing your auto loan. Your goal isn't just a lower interest rate, it's a lower monthly payment. Even if you only shave $75 off your monthly car payment, that's $75 that is no longer counted against you in the DTI ratio. Over the course of a year, that's $900 of borrowing power you just unlocked. The same logic applies to credit cards or other high-interest debts. Let's say you have 3 credit cards with minimum payments of $80, $90, and $100. That's $270 a month in payments hitting your DTI. Look into getting a single debt consolidation loan from a bank or credit union to pay off all 3. If that new loan has a single monthly payment of say $190, you haven't reduced your total debt by a single penny yet, but you've just instantly reduced your monthly debt obligations by $80 in the eyes of the mortgage lender. You've manipulated the DTI formula in your favor without needing a raise. That brings us to the other side of the coin. Strategy 4. Supercharging the I in DTI. We focused on lowering your debt, but what about increasing your income? And I don't just mean asking for a raise, although you should definitely do that. I mean making sure every single dollar you legally earn is counted by the underwriter. Most people only think about their base salary. That's a rookie mistake. Do you get an annual bonus? Do you earn commissions? Do you work overtime consistently? Do you have a side hustle driving for a rideshare service or doing freelance work? All of this is potentially qualifiable income. The catch, and this is crucial, is that you must be able to prove a stable history of receiving it, typically for 2 years. A single, one-time bonus from last Christmas won't count. But if you can show W-2s or tax returns proving you've received a bonus of between $5,000 and $8,000 every year for the last 2 or 3 years, an underwriter can average that out and add it to your monthly income. If you've been driving for Uber every weekend for the past 24 months, that's not a hobby. It's a verifiable income stream. You need to provide your tax returns, specifically the Schedule C, to prove it. The same goes for alimony or child support. If you have a court order and can prove a history of consistent payments, that counts. Don't leave money on the table. Comb through your finances and document every single source of income that has at least a 2-year history. Finally, there's strategy number 5, the nuclear option. This is for when you've tried everything else and you're still just on the edge. This is bringing in a co-borrower. A co-borrower, who is not your spouse, is someone who applies for the loan with you. They go on the loan and they go on the title of the house. Here's how it works. The lender combines your income and assets with their income and assets. If you make $5,000 a month and they make $5,000 a month, the lender now sees a household income of $10,000 a month. This can drastically improve your DTI ratio and get you approved for a much larger loan. But, and this is a massive but, the lender also combines your debts. If your co-borrower has a great income but also has a huge car payment, 2 student loans, and a bunch of credit card debt, adding them to your application could actually make your DTI worse. This is not a decision to be taken lightly. You are tying your financial future to this person. If you miss a payment, it destroys their credit. If they lose their job, you are still 100% responsible for the entire mortgage payment. This is a business transaction that should only be done with immense trust and a formal, written agreement between you and the co-borrower about how things will be handled. It can be a parent, a sibling, or a very trusted friend, but it's a powerful tool that can make the impossible possible. By attacking both sides of the DTI equation, aggressively lowering your monthly payments and meticulously documenting every penny of your income, you can fundamentally change your buying power. You can walk back into that lender's office with a completely different financial picture, without having waited years to get a promotion. But even with a DTI ratio that a lender would fall in love with, there's another number that can act as a brick wall, stopping your application dead in its tracks. A single 3-digit number that holds more power over your financial life than almost anything else. In the next part, we are going to pull back the curtain on the credit score, revealing exactly what underwriters are looking for and how to give them precisely what they want to see. So let's pull back that curtain. The credit score isn't some mystical, unknowable number handed down from the financial gods. It's a grade, a report card on your financial trustworthiness, calculated with cold, hard math. And the main grading system lenders use is called the FICO Score. Think of it like the SAT for your finances. There are other models like VantageScore, but when you're talking mortgages, FICO is the king. And this king judges you on 5 specific categories, each with a different weight. Understanding these 5 categories is the key to unlocking a great score and, ultimately, a great mortgage. The first and most important category, making up a massive 35% of your score, is your payment history. This is the bedrock of your entire financial reputation. It answers the single most important question a lender has. When you borrow money, do you pay it back on time? Every single late payment is a crack in that foundation. A payment that's 30 days late is bad. 60 days is worse. And a 90-day late payment can be catastrophic to your score, staying on your report for 7 long years. The same goes for more severe events like collections, foreclosures, and bankruptcies. They are giant red flags to an underwriter, screaming high risk. The strategy here is brutally simple. Pay every single bill on time, every single time. No exceptions. The best way to guarantee this is to automate it. Set up autopay for at least the minimum payment on every single account you have: credit cards, car loans, student loans, everything. You can always pay more manually, but that automated minimum payment is your safety net. It prevents a simple mistake like forgetting a due date from costing you dozens of FICO points and thousands of dollars in higher interest rates down the line. If you have had a late payment in the past, the best thing you can do is start building a long new history of perfect on-time payments. Time is the only thing that heals this wound. The second most influential category, weighing in at 30%, is called amounts owed, but what it really means is credit utilization. This is a fancy term for a simple ratio. How much credit you're using compared to how much credit you have available. Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance on it, your utilization is 50%. If you have a $1,000 balance, it's 10%. From an underwriter's perspective, a high utilization ratio signals that you might be overextended and relying on credit to live. It suggests you're close to your financial breaking point. People with the highest credit scores consistently keep their overall utilization below 30%, and the true superstars keep it below 10%. This is one of the fastest ways to boost your score. If you have high balances, paying them down will provide an almost immediate lift. But here's a pro tip. Your credit card company usually reports your balance to the credit bureaus on your statement closing date. This means even if you pay your bill in full every month, if you make a big purchase, your statement could close with a high balance, temporarily tanking your utilization and your score. The solution? Make a payment before your statement closing date to get that reported balance as low as possible. It's a simple trick that makes a huge difference. Next up, accounting for 15% of your score, is the length of your credit history. Lenders love to see a long, established track record of responsible borrowing. This category looks at two things: the age of your oldest account and the average age of all your accounts combined. An older credit history provides more data for them to assess you as a borrower. It shows stability. This is why the common advice to close old credit cards you don't use is often terrible advice, especially if it's your oldest card. Closing that account can dramatically shorten your credit history and lower the average age of your accounts, which can cause your score to drop. If you have an old, no annual fee card, keep it open. Buy a pack of gum with it every 6 months to keep it active, and let it sit there, silently anchoring your score with its age. The fourth category, accounting for 10%, is your credit mix. Lenders like to see that you can successfully manage different types of credit. There are two main types: revolving credit, like credit cards and lines of credit, where you can borrow and repay repeatedly, and installment loans like mortgages, auto loans, and student loans, where you borrow a fixed amount and pay it back in equal installments over a set period. Having a healthy mix of both demonstrates that you're a versatile and responsible borrower. Now, this doesn't mean you should go out and get a car loan just to improve your credit mix. That's a terrible idea. This part of your score will naturally develop over time as you go through life. The key is simply to be aware that a file with just a couple of credit cards isn't as strong as a file that shows a history of managing both revolving and installment debt well. Finally, the last 10% of your score is determined by new credit. This category looks at how recently and how often you've applied for new credit. Every time you formally apply for a loan or a credit card, the lender pulls your credit report, which results in something called a hard inquiry. A hard inquiry typically dings your score by a few points and stays on your report for 2 years, though it only really impacts your score for the first year. 1 or 2 inquiries here and there isn't a big deal. But a flurry of applications in a short period of time is a major red flag for underwriters. It makes you look desperate for credit, which signals financial distress. This is critically important when you're preparing to buy a home. In the 6 to 12 months before you apply for a mortgage, your credit application should come to a complete stop. Don't apply for that new retail store card to save 15%. Don't finance new furniture. Don't open a new credit line. Freeze everything. The only exception is rate shopping for a mortgage or an auto loan. The FICO models are smart enough to know that when you're looking for a big loan, you're going to shop around. So multiple inquiries for the same type of loan, like a mortgage, made within a short window, typically 14 to 45 days, will be treated as a single inquiry to avoid unfairly penalizing you. So to recap, payment history at 35%, credit utilization at 30%, length of history at 15%, and credit mix and new credit at 10% each. That's the formula. Your job is to look at your own credit report through the eyes of an underwriter and score yourself in each of these 5 areas. Go to annualcreditreport.com, that's the official, government-mandated site, and pull your reports from all 3 bureaus for free. Look for errors and dispute them immediately. See where you're weak. Is your utilization too high? Make a plan to pay it down. Do you have a history of late payments? Commit to a future of perfect, automated payments. Your credit score is the story of your financial life told in 3 digits. It's not about being perfect. It's about being responsible and consistent. By mastering these 5 components, you're not just gaming a system. You're taking control of the narrative. You are crafting a story that tells every lender you are a safe bet, a reliable partner, and someone who is ready for the responsibility of a home loan. But even with a perfect 850 credit score, there's another number that can kill your home loan application instantly. And most people don't even know how lenders calculate it. It has nothing to do with your past payment history, and everything to do with your current cash flow. In the next part, we're going to dissect the silent deal breaker, your debt-to-income ratio. It's the number 1 reason seemingly perfect loan applications get stamped with a big, red denied. And it has blindsided countless aspiring homeowners who thought they had all their ducks in a row. Imagine this: you've saved for years. Your credit score is sparkling. You found the perfect house. You submit your application confident, only to get a call from your loan officer with that dreaded, apologetic tone in their voice. They tell you, "I'm so sorry, but your debt-to-income ratio is too high." And you're left thinking, "My what?" This isn't just a number on a spreadsheet. It's the gatekeeper to your future home. Lenders see it as a direct reflection of your financial stress level. It answers one simple, brutal question for them. Can you truly afford this new mortgage payment on top of everything else you already owe? So, what is this mysterious ratio? Let's forget the banker jargon for a second. Think of your monthly income as a bucket. Every month, your paycheck fills this bucket to the top. Now, every single debt payment you have, your car loan, your student loans, the minimum payments on your credit cards, is a small hole in the bottom of that bucket. Water is constantly leaking out. The lender's job is to measure how much water is already leaking out before they add another, much larger hole for the mortgage. If your bucket is already half empty from existing debts, they get very nervous about adding a massive new leak. They're worried the bucket will run dry before you can pay everyone, including them. Your debt-to-income ratio, or DTI, is simply the percentage of your bucket that's already leaking out. The formula itself is deceptively simple. It is your total monthly debt payments divided by your gross monthly income. Let's say that again because the 2 most important words are total and gross. First, let's talk about the total monthly debt part. This is what trips most people up. What exactly does the bank count as debt? They are laser-focused on installment loans and revolving credit lines that appear on your credit report. This includes your car payments, student loan payments, personal loan payments, and the minimum monthly payments on all of your credit cards, even if you pay them off in full each month. They also include court-ordered payments like alimony or child support. Here's what they don't typically include: your monthly utilities, your cell phone bill, car insurance, groceries, or your Netflix subscription. Lenders assume you'll manage those living expenses. They are concerned with your contractual credit obligations, the payments you legally have to make every single month. Now for the second crucial word: gross. Lenders look at your gross monthly income, which is your income before any taxes, health insurance premiums, or 401k contributions are taken out. This is great news for you because it's the biggest possible number you can use, giving you more room in your DTI calculation. If you make $60,000 a year, you don't divide by your take-home pay. You divide by $5,000 a month. So let's put it all together with a real-world example. Meet Sarah. Sarah makes $72,000 a year, which is a gross monthly income of $6,000. Sarah is a diligent saver and has a great credit score. She feels ready. But let's look at her debts. She has a car payment of $450. She has student loans with a monthly payment of $350. And she has a few credit cards with a total minimum monthly payment of $150. So we added up $450 for the car, plus $350 for student loans, plus $150 for the credit cards. Her total monthly debt is $950. Now we do the math. $950 in debt divided by $6,000 in gross income equals 0.158. As a percentage, that's a DTI of 15.8%. Sarah's bucket is only about 16% empty before a mortgage. That's fantastic. Lenders will love her. But now let's meet David. David also makes $72,000 a year, or $6,000 a month. He's got the same credit score as Sarah, but David has a bigger truck with a $700 payment. He has the same student loans at $350, but he also has a personal loan for some furniture that costs him $250 a month, and his credit card minimums are a bit higher at $200. Let's add up David's debts. $700 plus $350 plus $250 plus $200. His total monthly debt is $1,500. Now let's run his DTI. $1,500 in debt divided by $6,000 in income equals 0.25, or a 25% DTI. Still pretty good, right? But we haven't added the house yet. This is where the magic numbers come in. Lenders look at two types of DTI, but they really only care about one. The first is the front-end ratio, which is just your potential mortgage payment divided by your income. The second, and the one that truly matters, is the back-end ratio. This is what we've been calculating. Your total debt, including the new mortgage payment, divided by your income. Most loan programs have a hard limit on this back-end DTI. For a conventional loan, the gold standard, lenders generally want to see your total DTI stay below 43%. Some can stretch to 45% or even 50% if you have a huge down payment or massive cash reserves, but 43% is the magic number to aim for. Let's go back to Sarah. Her DTI is 16%. The house she wants will have a mortgage payment of $2,000 per month. So, her new total debt would be her old debt of $950 plus the $2,000 mortgage, for a total of $2,950. We divide that by her $6,000 income. Her new back-end DTI would be 49%. Oh, even for Sarah, that's pushing the limit. The house she wants is likely too expensive for her DTI, even though her finances seemed perfect. The lender will likely approve her for a smaller loan, with a mortgage payment closer to $1,600, which would put her DTI right at that 43% sweet spot. Now look at David. He starts at a 25% DTI. If we add that same $2,000 mortgage, his new total debt is $3,500. Divide that by his $6,000 income, and his back-end DTI is over 58%. That's an automatic denial for almost any conventional loan. David isn't getting the house. It's not because he's bad with money. It's just that on paper, his bucket is leaking too much to safely add the new mortgage. This is the silent deal breaker. You can have a 800 credit score, but if your DTI is 55%, you're not getting the loan. Now, different loan programs have different rules. FHA loans are more forgiving, often allowing a DTI up to 47% or even over 50% in some cases. VA loans for veterans can also be very flexible, sometimes not even having a strict DTI limit if other factors are strong. But for the majority of borrowers, managing that back-end DTI is the entire game. So what do you do if your DTI is too high? You have two levers to pull, and only two. You either decrease your monthly debt, or you increase your monthly income. To decrease debt, the strategy is counterintuitive. It's not about paying off the highest interest debt. It's about paying off the highest payment debt. For DTI purposes, a $5,000 personal loan with a $300 monthly payment is far more damaging than a $15,000 credit card balance with a $250 minimum payment. If you can wipe out that personal loan, you just freed up $300 in your DTI calculation, which could translate to an extra $60,000 or $70,000 in home purchasing power. Focus on eliminating entire payments. Pay off a small loan completely. Sell the car with a huge payment and get a more affordable one. The other lever is increasing income. This means documenting every dollar you legally earn. Got a raise? Make sure your loan officer has the pay stub. Work a part-time job. If you've been there for 2 years, it almost always counts. For self-employed individuals or those who work on commission, lenders will typically average your income over the last 2 years from your tax returns. The absolute worst thing you can do before buying a home is to go out and finance anything new. Do not buy a car. Do not get a new credit card. Do not finance a new couch. Any new monthly payment, no matter how small, adds a new leak to your bucket and directly reduces the size of the mortgage you can qualify for. Your DTI ratio is the single most powerful number in your mortgage application. It's the raw calculation of your financial capacity. Understanding it, calculating it, and actively managing it is not just a good idea. It is the essential step that turns aspiring homeowners into actual homeowners. It's the key that unlocks the front door. But even with a perfect DTI, there's one final hurdle. It's the cash. The actual liquid money you need to bring to the table. This isn't just the down payment. It's an entire ecosystem of other costs that can add up to thousands, or even tens of thousands of dollars. And in the next part, we're going to break down every single dollar you'll need to save for your down payment and closing costs. So let's get into the brass tacks. When you buy a house, you need to bring a suitcase of cash to the table. This cash is split into two major buckets: your down payment and your closing costs. Think of them as two separate, non-negotiable savings goals. They are not the same thing, and you absolutely need to budget for both. Most first-time buyers are so focused on the down payment that the closing costs blindside them at the last minute, sometimes even torpedoing the entire deal. We are not going to let that happen to you. First, let's talk about the big one, the down payment. This is the portion of the home's purchase price that you pay up front. The rest is what you borrow from the lender. For decades, the myth has been that you need 20% down to buy a house. If you want to buy a $400,000 home, you need $80,000 in cash. For most people, that number is so demoralizing they just give up. But here's the truth for 2026. The 20% down payment rule is one of the biggest misconceptions in real estate. It's a great goal, but it is absolutely not a requirement. So what do you actually need? Let's break it down by the loan types we've discussed. For a conventional loan, many lenders now offer programs for first-time homebuyers that require as little as 3% down. On that $400,000 house, that's $12,000. A huge difference from $80,000. For an FHA loan, the minimum down payment is just 3.5%. That's $14,000 on that same house. And for our veterans and those in eligible rural areas, VA loans and USDA loans often require 0% down. That's right, 0. Now you're probably thinking, why would anyone ever put 20% down if you can put down 3%? And that is the multi-thousand-dollar question. The answer is something called PMI, or private mortgage insurance. If you put down less than 20% on a conventional loan, the lender sees you as a slightly higher risk. To protect themselves, not you, they require you to pay an extra insurance premium every single month. This PMI payment is rolled right into your monthly mortgage payment. It doesn't build you any equity. It doesn't pay down your loan. It's purely the cost of having a low down payment. How much is it? A good rule of thumb is to expect to pay between 0.5% and 1% of your total loan amount per year, broken up into monthly payments. On a $400,000 home with 5% down, you're borrowing $380,000. Your PMI could be anywhere from $150 to $300 extra every single month. That's money that just vanishes. Once you reach 20% equity in your home, you can request to have that PMI removed, but until then it's a constant drain. FHA loans have their own version called MIP, Mortgage Insurance Premium, which is even harder to get rid of. This is the trade-off. A lower barrier to entry but a higher monthly cost. So you've figured out your down payment. You've saved up your $14,000 for an FHA loan. You're ready to go, right? Not even close. Now we have to talk about the silent killer of home buying dreams: closing costs. I call this the second down payment because that's truly what it is. It's a completely separate pile of cash you need to bring on closing day. Closing costs are the collection of fees you pay to all the different parties who help facilitate the sale. The lender, the appraiser, the title company, the government, everybody gets a piece. A safe estimate for closing costs is to budget between 2% and 5% of the home's purchase price. So on our $400,000 example home, you need to be prepared to pay somewhere between $8,000 and $20,000 in cash, on top of your down payment. Are you seeing now why this trips people up? They say $14,000 for the down payment, get pre-approved, find a house, and then a week before closing, they get a statement that says they need to bring another $15,000 to the table. It's a nightmare. So let's demystify it. What are you actually paying for? First up are the lender fees. The biggest is often the loan origination fee. This is what the lender charges you for the service of creating your loan, doing the underwriting, processing the paperwork, and all the administrative work. It's usually around 0.5% to 1% of the loan amount. So on your $386,000 FHA loan, that could be $2,000 to $4,000 right there. Next, you have third-party fees. These are for services required by the lender, but performed by other companies. The first is the appraisal fee. The lender needs to know that the house you're buying is actually worth the price you're paying. They aren't going to lend you $386,000 for a house that's only worth $350,000. So they hire an independent appraiser to assess the property's value. You pay for this, of course. Expect to pay around $400 to $700. Then there's the home inspection. Please hear me on this. This is different from the appraisal. The appraisal is for the lender. The inspection is for you. This is where you hire a professional to go through the house with a fine-toothed comb and find any potential problems. A leaky roof, a faulty foundation, bad electrical wiring. This fee, usually $300 to $600, is the best money you will ever spend. It can save you from buying a money pit and give you leverage to negotiate repairs with the seller. Do not ever skip the inspection. Next is a big, confusing one, title search and title insurance. When you buy a car, you get the title. A house is the same, but its history is a lot more complicated. A title company does a deep dive into the property's public records to make sure the seller actually has the legal right to sell it to you, and that there are no old, outstanding claims or liens against it from previous owners, contractors, or even the IRS. Then, you buy 2 title insurance policies. One protects your lender and one protects you. It's a one-time fee paid at closing that protects you from ownership claims for as long as you own the home. This can easily cost over $1,000, but it's non-negotiable protection against a catastrophic legal problem down the road. Then you've got smaller fees that add up. Escrow fees for the neutral third party handling the transaction, courier fees, recording fees to file the new deed with the county, and so on. But the last major category of closing costs is called prepaids. This is where you prepay for certain ongoing expenses related to homeownership. The lender wants to make sure you won't default immediately, so they make you set up an escrow account and fund it up front. You'll likely need to prepay your first full year of homeowner's insurance premium. That could be $1,200 to $2,000. You'll also need to prepay several months of property taxes. Depending on your state and when you close during the year, this could be another couple $1,000s. You're not losing this money. You're just paying it ahead of time. But it's still cash you need to bring to closing. So let's do the math. You're buying a $400,000 house with an FHA loan. Your down payment is 3.5%, which is $14,000. Your closing costs are, let's say, 3% of the purchase price on the lower end. That's another $12,000. Your total cash needed to get the keys to your new home isn't $14,000. It's $26,000. That is the real number. That is the number you need to have in your savings account. It's a daunting figure. There's no sugarcoating it. It's the single biggest barrier to homeownership in America. Seeing that number can feel like hitting a brick wall. But knowing the number is the first, most critical step. Now it's not a vague, terrifying monster in the dark. It's a target. It's a goal. And this is where so many people get stuck. They see that final number, that $26,000, $30,000 or more, and they think, I'll never be able to save that much. They see their dream slipping away. But what if I told you that you might not have to save every single penny of it yourself? What if there were programs specifically designed to help you with that giant pile of cash? What if you could get the seller to pay for some of it? What if your family could help without messing up your loan? There are strategies and resources available that most people have no idea exist. And in our final part, we are going to uncover every single one of them. We'll show you how to find down payment assistance, how to negotiate closing costs, and the secrets to bridging that financial gap to finally make your dream a reality. Let's start with the biggest hurdle for most people: the down payment. For decades, the myth of the 20% down payment has crushed more dreams than almost any other piece of financial misinformation. But thousands of programs across the country are designed specifically to help you overcome this. These are called down payment assistance programs, or DPAs. Think of DPAs as falling into 3 main categories. First, you have grants. This is the holy grail. It's money you are given that you never have to pay back. It's a true gift to help you get into a home. Second, you have forgivable loans. This is an incredibly powerful tool. You're given a loan for your down payment, often at 0% interest, and if you live in the home for a set number of years, say 5 or 7 years, the loan is completely forgiven. It vanishes. It's their way of encouraging community stability. Third, you have low-interest loans. This is a separate, small loan that covers your down payment, which you pay back over time, often with a very manageable monthly payment. So, where do you find these magical programs? Your search starts at the state level. Every single state has what's called a Housing Finance Agency, or HFA. Your first action item after this video is to open a new tab and search for your state's name Housing Finance Agency. This is your command center. Their websites are a treasure trove of information, listing all the state-sponsored DPA programs you might qualify for, including income limits, purchase price limits, and first-time homebuyer requirements. But don't stop there. The search gets more local and often more lucrative. Go to Google and type in your city or county name down payment assistance. You will be shocked at what you find. Major cities and even smaller counties have their own programs funded by federal grants to promote local homeownership. These can sometimes be even more generous than state-level programs. Next, think about your profession. Are you a teacher, a first responder, a healthcare worker, or a veteran? There are specific DPA programs designed as a thank you for your service to the community. These are often called Good Neighbor or Hometown Heroes programs. They can offer significant assistance, so be sure to search for programs specific to your line of work. Finally, don't overlook employer-assisted housing programs. A growing number of companies, especially large ones, offer DPA as a benefit to attract and retain talent. Check with your HR department. It could be the most valuable employee benefit you never knew you had. Now, a critical warning. When you find these programs, you'll see they have rules, income limits, credit score minimums, and you almost always have to complete a homebuyer education course. Do not be intimidated by this. The income limits are often much higher than you'd think, especially in high cost of living areas. And the education course? It's one of the most valuable things you can do. It's a free masterclass in owning a home successfully. Embrace the requirements. They are gateways, not gatekeepers. Okay, so you've secured help with your down payment. You're feeling incredible. But then your lender mentions another massive expense: closing costs. These are the fees for everything from the appraisal to the title insurance to the loan origination, and they typically run anywhere from 2 to 5% of the home's purchase price. On a $300,000 home, that could be an extra $6,000 to $15,000 you need to bring to the table. For many, this is the final unexpected barrier that kills the deal. But this barrier can be negotiated, and the most powerful tool in your negotiation arsenal is called seller concessions or seller credits. This is the art of having the seller pay for some, or even all, of your closing costs. Here's how it works. Let's say you agree on a purchase price of $300,000, and your closing costs are $9,000. You can ask your real estate agent to write the offer like this. You'll pay $309,000 for the house, but you require the seller to give you a $9,000 credit at closing. What just happened? The seller still nets their $300,000. The home's value supports the higher price for appraisal purposes. But for you, the $9,000 you needed for closing costs is now financed as part of the loan. You just turned a massive out-of-pocket expense into a small, manageable addition to your monthly mortgage payment. It is, without a doubt, one of the most effective strategies for cash-strapped buyers. The amount you can ask for is limited by your loan type. FHA loans typically allow up to 6% of the purchase price in seller concessions. Conventional loans are often around 3%. This is where having a brilliant real estate agent is non-negotiable. A great agent knows how to position this request, especially in a balanced or buyer's market, to get your offer accepted without a fight. But there are other ways to slash closing costs. First, shop around. Your lender will give you a list of preferred providers for things like title insurance and homeowners insurance, but you are not required to use them. You have the right to shop for these services. Spend an afternoon making calls. You could save hundreds, even thousands of dollars. Second, ask your lender about a lender credit. This is similar to a seller credit, but it comes from the lender themselves. In exchange for you accepting a slightly higher interest rate, maybe an eighth or a quarter of a percent higher, the lender will give you a credit to cover some or all of your closing costs. This is a strategic trade-off. If you're short on cash now but can afford a slightly higher monthly payment, this can be the move that gets you the keys. Now let's put it all together. This is the secret. This is how people with average incomes and modest savings are buying homes right now. They are not using one of these strategies. They are stacking them. Imagine this scenario. You find a home you love. You qualify for an FHA loan, which only requires a 3.5% down payment. Then, you discover a state DPA grant that covers that entire 3.5%. Suddenly, your down payment is zero. Next, you negotiate 3% in seller concessions, which covers the bulk of your closing costs. And maybe your parents give you a small gift of a few $1,000s, fully documented with a proper gift letter, to cover the remaining closing costs and appraisal gap. What just happened? You just got into a home with almost no money out of your own pocket. This isn't a fantasy. This isn't a scam. This is a strategy. It's a combination of the right loan product, the right assistance program, savvy negotiation, and a little help. It is the blueprint. This brings us to the final, and perhaps most important piece of the puzzle we've assembled over these 10 parts. From understanding your why and conquering your financial psychology, to meticulously rebuilding your credit, mastering your debt-to-income ratio, getting pre-approved, and navigating the emotional roller coaster of the home search, it all culminates in this. You cannot do it alone. The secret weapon that ties all of this together is your team. You need a loan officer who is a specialist in DPA programs, not just someone at a big bank who only knows how to do conventional loans. You need a real estate agent who is a shark, a master negotiator who lives and breathes contracts and knows how to win you seller concessions. These people are out there, and finding them is your final mission. Ask them about their experience with first-time homebuyers. Ask them which DPA programs they've closed loans with recently. Their answers will tell you everything. The journey to homeownership is a marathon, not a sprint. We've covered every single step of the race. We've given you the training plan, the nutrition guide, and the map of the course. We've shown you that the obstacles you thought were mountains are merely hurdles you now know how to clear. The American dream of owning a home is not dead. It has just changed. The rules are different now. It requires more knowledge, more strategy, and more grit than ever before. But it is more accessible than you have been led to believe. The information in this series is your key. The path is laid out before you. The only thing left is for you to take the first step. Your future is not something that happens to you. It is something you build one smart decision at a time. Now go build it.